Okay, Module 3. Module 3, we're looking at financing and evaluating investments. There are two types of risk: business risk and financial risk. Business risk is to do with organizations' investment decisions. So this is more asset side of things. This depends on relationship between operating income expected from an organization's assets and general economic conditions. Essentially encompasses the inherent risk posed by the organization's business activities, whereas financial risk, this is to do with financing decisions. This is more to do with liability side. In general, the higher the proportion of debt financed, that means there's a greater variability of returns to shareholders. But also this means there's higher degree of financial risk. So business risk is more inherent and operational side of things, whereas financial is very finance side of things. In order to go through the financing decisions, we need to look at sources of funds for the business. So part A goes through the sources. The first one will be short and intermediate financing. Short-term financing has a maturity of less than 1 year generally, and intermediate-term financing is around 1 to 5 years maturity. We're gonna look at short-term financing first. Firstly, it will be money market instruments. This is short-term debt instruments which pays a pre-specified amount at the maturity. So they're gonna pay face value at maturity like bond, but there's no intermediate interest payments for money market instruments. This includes promissory notes, or we call it commercial paper. This is a negotiable instrument, so tradable instrument used to create or secure a debt. This is traded on the strength of the name of the issuing company, so this does not require endorsement of a third party. Basically, just relying on this company that they're strong and they're secure, so we're borrowing money from them. This will be issued at discount to their face value in multiples of $100,000, and this is redeemable at par on maturity. This note must be for a specific amount and specific time of repayment. So this is basically transferring title from issuer to the payee or the lender or the bearer. So second one is negotiable certificates of deposit. This is a security issued by a bank in exchange for deposit of funds. These certificates are traded in the market at rates similar to those of bank accepted bills. This is basically issuing banks transferring amount deposited plus interest to the bearer on a specified date. So another one would be bank overdraft. This is a form of bank lending whereby a customer can overdraw a current account up to agreed limit. So this is typically used to cover fluctuating working capital requirements, and it may be secured by a fixed or floating charge over assets. The disadvantages of this bank overdraft would be it is payable on demand, so that is at call. The lender may vary the interest rate at its discretion. There may be interest charges on the daily balance owed. There may be nominal charge on the unused balances, so unused limit fees, and there's establishment and service fees. But this is tax deductible. You can claim it as expenses under your business. So for medium-term fundings, there are a few. So fully drawn advances. There is a specific requirement for debt finance. It is normally drawn in full at the outset. It provides a lump sum amount to the borrower at the start of the loan. And this is to finance a specific capital need. And it is not discounted instruments but are repaid over a fixed term by regular repayments of principal and interest. So this is more for a specific capital need. Whereas term loans, this is advances of funds repayable in full by a fixed date, which is to provide consumer credit, mortgage finance, and various forms of personal finance. The advantage of having this is the certainty associated with the conditions of the loan term, such as repayments. But the disadvantages are variability of interest rate, which is at the lender's discretion. There's a stamp duty that is charged on the face value of the loan. Well, this applies for Australia. And there's an inflexibility of their condition. For the trade finance, this is used by SMEs, by both importers, exporters, and other types of international trades, as it is called trade finance. The risk of this will be geographic separation, operations under different legal and banking systems. There's a challenge of recovering and returning goods if there's a warranty and you want to return. There's a use of international remittances using foreign currencies, and There's new and unfamiliar political and economic risks associated with cross-border trading. When you use trade financing, there's something called documentary letter of credit, DLOC. This is a letter of promise by the bank to pay an exporter as long as the exporter complies and delivers according to the terms of documentary letter of credit. Another form of financing will be equipment financing. The advantage of this is it has access to property, plant, and equipment and software without a large initial outlay. It also shows predictable cash flows, which can assist in cash budgeting. So equipment financing, there are a few ways that you can do this. Number one is leasing. There's an international standard for this, IFRS 16, which covers leases only. This is when the lessor gives the right to use to lessee, and lessee has to make periodic payments. The advantage of this is leasing installments attract GST, so leases can claim an input tax credit if they're registered for GST. This also specifies the amount of any guaranteed residual value included in the lease payments. Residual value means it's estimated fair value of their leased property at the end of the lease terms, based on the price levels and market conditions existing at the time of the lease is entered into. Within the lease, there's also two types of leases: finance lease and operating lease. The differences would be finance lease transfers substantially all the risk and rewards incidental to the ownership of an underlying asset from the lessor to lessee. Whereas for operating lease, that is otherwise. They don't encompass all the risk and rewards. It's not transferred to the lessee like finance lease. Also finance lease, lessor recognizes a lease income over the lease term consistent with the pattern that reflects a constant periodic rate of return on the net investment. It is the lessee's obligations to recognize right of use assets and the related liability in balance sheet, except when leases are for short term or involving low value assets such as computers, where a lessee can elect to account for lease payments as an expense, not in the balance sheet. So what are the right of use asset and lease liability? Right of use asset is initially measured at an amount of the lease liability plus any initial direct cost incurred by the lessee. So lease liability plus initial direct cost. The adjustments may also be required for lease incentives, payments at or prior to commencement, and restoration obligations or similar. This is subsequently measured at cost minus accumulated depreciation and accumulated impairment. For lease liability, this is initially measured at present value of the lease payments payable over the lease term, discounted at the rate implicit in the lease. Subsequently, when the lease liability is increased, this goes to interest on the lease liability, and if it's reduced, then that means the lease payments have been made. The carrying amount is also subsequently adjusted to reflect any changes in the lease term or the amount expected to be payable under residual value guarantees and other factors. So that was for leases. Another form will be hire purchasing. That is a method of acquiring specific goods by periodic payments or installments. The difference between lease and hire purchase will be when it comes to hire purchase, the ownership passes to the user when all the payments have been made. So lease is just borrowing the whole time until the lease period ends, whereas for hire purchase, when you finish paying off the payments, then all the ownership is passed down to the user. Lastly, there's factoring. There are two types of factoring: full recourse factoring and non-recourse factoring. When I searched up recourse, that is the legal right to demand compensation. So full recourse factoring, that's when the factorer does not take on the credit risk associated with the bad debt. Firstly, when an organization gives a portion of accounts receivable to the factorer, then the organization gives the factorer cash as the debtors settle, up to the point at which those debtors is more than credit terms extended to them by the organization. Then the factorer sells the outstanding accounts debtors back to the organization. This means when the credit terms expire, the factorer sells the debt back to the organization. Whereas non-recourse factoring, this is the one I think I'm more familiar with, is when factorer takes on the credit risk associated with the bad debt. So when organization sells a large debt account at discount to their fair value to the factorer, that the factor bears the credit and default risk of the debt. So the title of the account's debtor is all passed down to the factor, so they're not selling back at anything. This applies mainly to large invoices where an organization has a large exposure to one organization. And this is riskier for the factor because the factor bears the credit and default risk of the debt. But this is also compensated by a higher yield received on the debt. The advantages of factoring would be it allows the selling organizations to bring cash receipts forward. This will reduce the adverse cash flows effect of the organization. And also it can outsource the collection of debtors to factoring company, which allows an organization to focus on their core competency. The disadvantages of factoring would be the factor purchases debtor account at a discount to their face value. So if the cost of discount is more than benefits gained by the bringing forward cash receipts, then there's no point of factoring in the first place. Also, it can create a negative impression with the company's debtor whose account have been factored. If I'm paying a company to do something, but then I find out that I'm not paying to that company, is paying to some other company, and they have all my information, I wouldn't want that. So there's some confidential issues as well. Let's go through some examples. When it comes to large retail chain, what might they use? They might use more flexible financing facilities such as commercial bills, bank borrowings, or trade credits, which will finance its ongoing working capital needs relating to inventory and debtors. It might use also longer term financing such as leasing and term loans for its premises, fixtures, and fittings. When it comes to new car dealers or suburban furniture stores, then they might use more flexible financing facilities such as leasing, commercial bills, and bank overdraft for its premises, inventory, and other working capital needs. When it comes to local subsidiary of multinational motor vehicle manufacturer, then similarly, they might use a flexible financing facilities such as bank overdrafts, commercial bills for its short-term needs, and also it might use parent company's loans to finance its needs. So that was for short and intermediate term financing. Now we're gonna look at more longer term debt financing. So when it comes to time profile of debt, there are two things you need to consider. There must be a spread in the timing of fundraising and renegotiation to ensure the company is not ambushed by a debt crisis. Also, secondly, time to maturity needs to be spread in case of spikes in interest rates that could seriously affect achieving acceptable all-up funding cost. So fundraising and renegotiation, there needs to be a spread. Also, time to maturity needs to be spread in case there's an interest rate risk. What's other than government bonds? Who are non-government debt issuers in Australia? There's financial institutions, other corporate issuers, asset-backed issuers, and not resident kangaroo issuers, more like foreign bonds. What is a typical normal vanilla bond? That is a payment of a fixed amount, so coupon, based on the face value over a period of years. Or there's a variable income, so floating rate notes where payment is by reference to a benchmark such as bank bill swap rate. Bonds listed on exchange, it can be traded at a price that changes with current interest rates, which include a credit spread based on the perceived creditworthiness of the issuer. For example, a bond may be issued at coupon rate of 6% with a face value of $100. If the company's credit rating is downgraded, then the resale value might be $85. Then the running yield will be 6% times face value, so $6 divided by 85. The running yield will be 7.06%. Most semi-government bonds are issued with fixed rate interest coupon for maturities of 5 or 7 or 10 years. Corporate bonds are lagged behind both the Australian corporate loan market and corporate offshore bond market due to corporate being well serviced by bank and syndicated loans. I guess companies in Australia don't really issue bonds that much because they are well serviced by banks and syndicated loans that they don't need to issue that much bonds. And also there's an increased ability to secure funds in the offshore bond market, which provides a natural hedge against foreign currency exposures. Other forms of capital raisings include asset-backed securities, for example, residential mortgage-backed securities. This is like the Big Short, which didn't work out for global financial crisis. There's also debentures. This is a security issued in exchange for a secured loan obtained from an institution. This normally carries a fixed interest rate and have a fixed maturity date at which the face value is repaid. So most company debentures are listed on the stock exchange, ASX, and it may be issued at a premium or discount. This is secured by a fixed charge over a specific asset, and it may be issued through a general offer to the public, a private placement with a financial institution, or an offer to an existing shareholder or debenture holders, known as the family issue. So debenture has a trust deed, and a trustee is appointed to ensure that the company complies with the conditions of the contract and to take legal action to protect the interests of debenture holders should the company violate any of the conditions of the trust deed. These conditions typically include restrictions on future borrowing to ensure that the position of debenture holders is not prejudiced by the company raising additional debt in the future. Liabilities, where the trust deed may also require companies to maintain a specified asset balance and earnings requirements to ensure that debenture interest can be met out of the company's current earnings, and it may also specify an interest coverage ratio. So that was debentures. Unsecured notes or subordinate notes is a security issued in exchange for a loan. So this is committing the borrower to a series of periodic interest payments and repayments of the principal on the maturity date. This ranks behind debenture holders, and it ranks equally to the trade creditors as it is not secured. This carries a higher interest charge than debentures. So when it comes to debt structuring, there are 4 different types of debt structuring. Debt repurchase program is when a company makes a formal repurchase offer to debenture holders, by which the company offers to redeem all outstanding debentures. Debt repurchases on the open market is alternative to repurchase offer in case bearer securities are involved. Debt switches is when a company enters into an agreement with its debenture holders which they agreed to early redemption of existing debentures and to receive alternative securities. Debt deficence is when some debenture holders may be unwilling to recognize the loss that would arise if they accepted a formal repurchase order, thereby blocking a debt restructuring plan. So what's a negative pledge borrowing? This technique involves raising unsecured debt, usually from banking sector, where the borrower provides undertaking not to provide a higher ranking security to any other lender. The disadvantage would be the pledge is difficult to enforce because the borrowing is unsecured. But the advantage would be the assets of overseas subsidiaries can be included in the definition of total tangible assets. So when it comes to seniority of debt instruments, the first would be debentures, as it is being secured by a floating charge over the organization's assets, and then all other liabilities in the organization. And then third would be subordinated or unsecured debt. And lastly, it will be equity capital. Short-term financing would be less costly because short-term interest rates are generally lower than the long-term interest rates, but then it has higher risk because of its refinance risk, the possibility that organization may not be able to roll over its short-term debt obligations when it's due. There's actually interest rate risk because of the uncertainty associated with what short-term interest rates will be like in the future. So what are some other offshore long-term debt and equity fundraising sources? So foreign bonds are issued by a borrower to investors in a country other than the borrower's home country, with the bonds being denominated in the investor's currency. So for example, for BHP Billiton, this is issued in Australia and it is issued to investors in Tokyo in Japanese currency. So it is issued by a domestic borrower to a foreign investor in foreign denominated currency. So there are different names for these foreign bonds. For example, Australian dollar denominated bond is called kangaroo bond, and the issuing market will be Australia, and the issuer or the borrower will be a non-Australian entity. I'll go through all the names of different foreign bonds So Bulldog bond is denominated in British pound sterling, GBP, and the investor will be in United Kingdom, UK, but the issuer will be a non-UK based issuer. Maple bond is denominated in Canadian dollar, and the investors are in Canada, but issuer will be a non-Canadian borrower. Panda bond is Chinese yuan, and the investor will be in China. Samurai bond is denominated in Japanese yen, and this is issued in Japan. Yankee bond is denominated in USD, and it is issued in US. Those are some of the foreign bonds, and it is named differently. When it comes to euro market, there's euro currency market. Euro currency doesn't mean euro. This euro currency market is a market where currency is deposited in and loaned by a bank that is located in a country that is not the native country of the currency. So for example, the market for US dollar will be outside of US. For euro Australian dollar, the market for Australian dollar would be outside of Australia. So if I deposited US dollar in a bank, then the bank would be outside of US. If I deposited Australian dollar in Euro Australian dollar market, then that means I deposited Australian dollar in a bank that is outside of Australian market. And these banks are called Euro banks. So what are Euro bonds? Euro bonds are fixed interest bonds usually underwritten by a syndicate of international investment banks. So these are sold in countries outside the country in whose currency the bond is denominated in. The maturity is typically 5 years, and three main factors that have driven the growth of Eurobond market will be the absence of regulatory interference, relatively limited disclosure requirements, and in some areas there are tax anonymity. What is a floating rate note? This is a long-term bonds where the interest rate is periodically adjusted according to the benchmark interest rate. For example, London Interbank Offered Rate, LIBOR. So what's a private placement and depository receipts? Private placement market is the non-public offering of securities that are sold to a small number of selected large investors. So this is different to IPOs where you do public offering for large number of investors. This does not have to be registered within US SEC if the placement conforms to the issuing guidelines for exemptions from the Act and associated SEC regulations. So this means there is less costly way to issue and administer equity raising in the US equity markets. When it comes to depository receipts, this is a security that trades like an ordinary share on a local exchange and then represents an economic interest in a foreign firm. So it will be where a foreign firm deposits listed equity share into depository bank in the local exchange, and the local depository bank issues depository receipt to the investors. So for the depository bank, they have a responsibility to act as a custodian and as a registrar, which entails handling dividend payments, other taxable events, stock splits, and serving as the transfer agent for the foreign firm whose securities depository receipt DR represents. A depository receipt, a DR, can be a sponsored DR or unsponsored DR. Sponsored ones is when the foreign firm whose shares are held by the depository is directly involved in issuing receipts. So the right for investors is same as the direct owners of the ordinary share. This generally subjects to greater reporting requirements than unsponsored DRs because they have more direct involvement in this. However, for unsponsored DR, this does not involve in issuing the receipt. So the depository purchases the foreign firm shares in the domestic market, then issues the receipt through brokerage firms in the depository's local market, and the depository bank retains the voting right. There are two types of depository receipts. Global depository receipts is when the foreign firm is outside the home country and they transfer the deposit share to the depository bank in the local exchange and issues the global depository receipts to the investors. The key advantage of this will be it is not subject to foreign ownership and capital flow restrictions that may be imposed by issuing firm's home country because they're sold outside the country. Issuing firm selects the exchange where the GDR is to be traded based on factors such as investors' familiarity with the firm or the existence of large international investor base. For American depository receipts, as the name entails, it is to do with America. It is a US dollar denominated security that trades like a common ordinary share on US exchanges. For global DR, it cannot be traded in the US, whereas ADR can be traded in the US. There are 4 primary types of American depository receipts. The level 1 can be traded in the OTC market, and it does not require full registration with SEC. Level 2 and 3 can be traded on New York Stock Exchange, Nasdaq, and AMEX, and it allows firms to raise capital and make acquisitions using these securities. However, the issuing firm needs to fulfill all SEC requirements. The 4th type of ADR does not require SEC registration. We're gonna jump into equity financing. So there's primary market and secondary market for equity. Primary market is more to do with when ASX listed companies raise more money for the first time in the form of IPOs, rights issue, dividend reinvestment schemes, and employee share ownership schemes. Secondary market is where shares in listed companies are bought and sold. So this is not raising money, it is bought and sold, and it has no direct effect on the underlying viability or profitability of the company concerned. There are 3 forms of equity financing. There's ordinary shares, which is a security that implies ownership of a company's assets with a residual claim to any dividend paid by the company. Each ordinary share carries 1 vote. Bonus share is like an ordinary share that are issued by a company but for no consideration. So this increases the number of ordinary shares on issue, and this results in the price per share decreasing in direct proportion to the number of bonus shares issued, because this is treated as an ordinary share as well. Venture capital is a type of equity capital that is sold and provided to higher risk startup ventures. Australian regulation says companies, both public or private, are required to have at least 1 member or shareholder. Proprietary companies must have less than 50 non-employee shareholders and at least 1 director, and that director must be resident in Australia. For a public company, they must have at least 3 directors and at least 2 directors must be resident in Australia. So for mechanisms for raising equity capital, firstly, there's a primary issue. Also, it is called new float or initial public offerings, IPOs. 2 main parts for this. When preparing for the float, the company may need to be restructured before the float. So underwriters are normally appointed to manage the float. Underwriters are mostly investment banks, and they're responsible for preparing documents and legal requirements and all that kind of investment banking stuff. For pricing the issue, this involves the valuation techniques, including NPVs, price earnings multiples, and cash flow multiples, and all that kind of valuation stuff. The underwriter normally conducts a book building exercises to establish likely bids, and this is done because a heavily oversubscribed issue normally means that the issue is underpriced and pre-float owners will not be fully compensated. There's another mechanism, it's called rights issue. The first one was primary issue, second one is rights issue. It's also called pro rata issues. This is when a company gives each existing shareholder a right to buy additional shares in the company at a specified price. As the name suggests, it is in proportion to shares held. This can be renounceable rights issue, where it entitles the shareholders to purchase additional shares through paying premium or to sell the right to purchase shares on the share market. Shares can be issued on a partly paid basis, that is, a proportion of the cost is deferred. Non-renounceable rights issue or entitlement issues cannot be traded on the share market. That is, the shareholders cannot renounce their rights to purchase additional shares by selling the rights to the share market. Renounce means give up. If a shareholder does not take up the rights, then underwriter to the right issue will be able to take up the rights. So how do you calculate the rights issue? Theoretical rights issue formula for this is number of existing shares that must be held to receive the new issue times the market price of the existing shares post announcement, so share price before the issue, minus the subscription price for the new share divided by bracket numbers of existing shares plus 1. So for example, a 1-for-5 issue at $2 per share where the market price of the existing share is $3, then the theoretical rights value would be 5 times 3 minus 2 divided by 5 plus 1. So this is used where a company needs to raise funds to finance an acquisition or for investment or to reduce the level of debt within the organization. Third mechanism would be placements. The disadvantage of this would be existing shareholders are left out of the issue, and this can take place without the approval of ordinary shareholders. However, the advantage would be the speed with which placement takes place. So companies can raise funds quickly, and the cost involved in placement is lower than rights issue. There's another mechanism called dividend reinvestment plans, DRP. This is popular for 3 reasons. It is simple and efficient way for listed companies to raise capital. It may be difficult for companies to raise funds when the share market is in bearish period. So DRP may be more effective way to do this. And it provides companies with a means to distribute the franking credits associated with dividend payments to shareholders without actually having to pay those dividends. There are another mechanism, so employee share ownership schemes. There's company issued options. Is often issued free to staff, especially as part of executive incentive schemes. There's also partly paid shares, which is an alternative to share options, leaving shareholders with an on-call liability rather than right to exercise to buy shares. On-call liability means the outstanding amount that remains payable on share issue is equal to the amount is yet to be called for by the issuing company. So we just went through the mechanisms for equity financing. Now there's another form of financing which is called hybrids. This includes both debt and equity side of things. One example would be convertible notes. So this is a debt instrument that gives the holder the right to convert the debt to a company's ordinary shares at a future time, or to ask the company to refund the subscribed amount of funds. If the right to convert is not exercised, then the notes are repaid in cash at face value on the maturity date. The main form would be convertible unsecured notes, so this is unsecured. The advantage of convertible notes would be for the issuers, since they incur interest expenses, this is tax deductible. And for investors, they receive income in the form of interest, and there's a potential future capital gain. So for convertible notes, it gives a measure of certainty for investors because it provides a regular income flow. And this enables investors to participate in a range of share issues that the company may take during the life of convertible notes. There's another mechanism called exchangeable notes. This is similar to the convertible notes with the exception that they're not issued by the principal corporation but by a third party. The issuer is responsible for facilitating the conversion of the notes into ordinary securities at a pre-specified future date. There's another one called preference shares. This is an equity securities that do not imply ownership of a company's assets, which provides right to vote only on issues that affect preference shareholders, and this received priority over ordinary shareholders when a company is liquidated. There are 5 types of preference shares. Converting preference shares enables conversion into ordinary shares at a specified ratio or dollar value at a pre-specified future date. Cumulative preference shares provides for preference shares to carry a specified dividend rate. If any shares dividend is missed by the company in a particular period, then that missed dividend is added to the dividend that is payable in the next period. Participating preference shares allows for an additional dividend to be paid above the specified shares dividend rate if the dividend to ordinary shareholder is increased. Redeemable preference shares enables investors to ask that their funds be returned to them at the end of the fixed term. Reset preference shares provide for a general fixed percentage rate of return, where the rate of return can be adjusted in line with movements in an underlying benchmark interest rate, for example, bank bill swap rate. The issuer can choose to extend the term on specified reset dates with new conditions. and the shareholder can choose to accept or decline the new conditions. So banks are particularly attracted to hybrid securities for two reasons. They can be classified as a Tier 1 assets under Basel III liquidity requirements, and also they allow banks to distribute franking credits earlier than they would otherwise be possible. So we just went through debt and equity and hybrid funding sources. We can look at global financial crisis, which had the implication from the capital raising. There is this term called credit rationing, which is when the lender's supply of funds is less than borrower's demand at the quoted contract terms. This will lead to small and medium-sized companies generally faced with tightening of credit terms as the demand from the borrower is more than the supply from the lender. As for European sovereign debt crisis, there's this term called austerity program. This is economic policies implemented by a government to reduce public sector debt by significantly curtailing government spending, particularly when a nation is in jeopardy of defaulting on its bonds. So yeah, it's trying to reduce the government bond, and this was used during the European sovereign debt crisis. So 4 areas of funding that the board of directors need to pay attention to would be: first, permissible level of gearing within the organization and policies to correct any decline towards unacceptable levels. Secondly, long-term plan to refinance the company. 1 year of planning is insufficient if there is a cyclical downturn. Thirdly, level and form of standby sources of financing, especially short-term liquidity needs. And lastly, exit strategies if required.